Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and tonight we are running through the September 2024 property market update, Australian property market update. So strap yourselves in. We've got some data coming your way, and I'll also give you a forecast based off the 18-year land cycle of where we're heading for the remainder of this year and into next year. So to kick it off, this is the month-on-month dwelling price indicator from CoreLogic. We saw a 0.4% increase for September nationally, with Perth leading the charge, up 1.6%, followed by Adelaide, up 1.3%, followed by Brisbane, up 0.9%, so just under 1%. Sydney flat, Melbourne slightly negative by 0.1%, Canberra down 0.3%, and Hobart 0.4%. So strong upturn from the smaller metros being Brisbane, Perth, and Adelaide. As expected in the second half of the 18-year land cycle, they continue to outperform, and more subdued growth from Sydney and Melbourne. We don't particularly look at Canberra and Hobart, but Sydney and Melbourne, we are proactively investing in these markets. They are coming towards the back end of their subdued growth, and they're yet to tick into the up cycle, but we'll get into that shortly. But as you can see, good, strong performance from Brisbane, Perth, Adelaide. However, they're not necessarily the markets you should be investing in now, as they have had significant growth over the last few years. This is the auction clearance rates, just from not last weekend, but the end of September. As you can see, Victoria, yeah, 55%, New South Wales, 54%, Queensland, 38%, South Australia is strong, 73%, WA is down. So we've had a bit of more stock come onto the market in recent weeks. Coming into spring, historically, there's a spike in new listings, and this has become more evident in the last couple of weeks. A lot of people look to hold out and sell in spring, as they think you get a better result from better lighting and the way the property presents. But the irony is the increase in stock, being the increase in the amount of listings to sell, provides a lot more options. This then softens the market for the period of spring and coming into Christmas as well, which we can see reflected in these clearance rates. So typically over, say, 70% clearance rate, where you run auctions and 70% of the stock is sold within that weekend, is considered a strong market. Above 70, 80, like 80%, that's really a booming market. Less than 50 or less than 60, 50 is more of a modest growth, and less than 40, 50, that's a soft market. I guess you can see Brisbane or Queensland and Western Australia have lower numbers, even though they are having good, strong growth. Auctions are used lesser up in those regions. So this is I guess a general indicator to give you an indication of how competitive the markets are within a short period of time. So if you're looking at the next, say, 2 to 3 months to buy or sell, these clearance rates can give you a good indicator of how the individual regions are performing and what you can expect. So if it's above 30, 70%, then you can expect it to be a very competitive market, and stock sells within a couple of weeks, if not within a week. If it's less than that 60%, then it's more of a balanced market, and makes it easier to get good deals. So things to keep a watch on, but now is a good time coming into Christmas, as we've got a spike in new listings, softer clearance rates. It's a good time to buy, not necessarily sell, but I particularly like buying this time of year and coming into Christmas, especially in December. when people are thinking about going on holidays, Christmas parties. Not many people are looking to commit to an asset, buying an asset just before Christmas. So there is a drop in demand, which ultimately provides you better opportunity if you're willing to put a deal together towards Christmas, because the sellers know if they don't sell before Christmas, they'll be waiting, February, March to sell their assets. So there is a bit of urgency there. So you can capitalize on that urgency coming into Christmas to get a good deal. So now's a good time to buy. Next slide, we have CPI is now down to 2.7%. How good? So this is inflation. I mean, the RBA's target is within the 2 to 3% band, so we've just scraped into it. I mean, don't get too excited. Uh, the RBA's commentaries, they want to see inflation stable within the band. So we've just sort of tapped into it over the last couple of weeks with the new data that's come out. So as of August, um, but the RBA will want to see it consistently maintained within the band before they probably look to drop interest rates. So, but this is a promising sign. Inflation's come down within the band. It just needs to be maintained within the band before the RBA will look to drop rates. But promising signs ahead. So as I was saying, the RBA's target for inflation is within 2 to 3%. So we're now at 2.7. So if this is maintained on every month for the next few months, it is a promising sign that potentially rates may not go up any further than they are now. I can see them probably staying at the cash rate, 4.35% for the remainder of this year at least. And if we do get the monthly indicator within that 2 to 3% consistently over the next 6 to 12 months, then we could expect a rate cut or two next year. So that's good. That's promising. They've made commentary that they don't expect to cut rates until 2026. So time will tell. But the states have already cut rates by 0.5%. And historically, if you can see even on the graph, the states is blue, Australia is grey. Australia typically trails 6 to 12 months behind the US. So prior to the GFC, the US started dropping rates, and we were 6 to 12 months behind. I guess prior to COVID, we were at a lower base, and early 1995, again, rates started dropping, then Australia trailed. So we can expect, based off history, 6 months after, between 6 to 12 months, you can expect a rate cut. So thing to note though is the US is coming off a higher base, so they went a lot harder and more aggressive. So they're down to 4.8% or so. So they're still above where we are. So I guess the average is around that 5% cash rate. So we're more or less slightly, I guess, above the cash rate if you're looking from what the banks are lending. But in the next, I guess, 6 to 12 months, we could expect a rate cut or two. So time will tell, but it's promising signs on the horizon. Definitely, even the banks are starting to discount their fixed interest rates. So that's also a promising sign. So they're expecting rates to come down in the next year or so. So now I also see as a good opportunity, one, while rates are higher, it's holding a lot of people back. Come next year, if we get a rate cut or two, and then in 2026, the market will be cranking again because a lot more people will be able to get finance, and then there'll be a lot more demand into the market. So if you can buy now, now's a good time to get in while rates are higher, holding a lot of people back because there was less competition now from serviceability reasons. Once rates are dropped to a lower level, then it is going to be like the roaring 20s again. So very excited for the next coming years, but now is a good opportunity, sweet spot in the window, especially with the higher listings out of spring, higher rates coming into Christmas is a good time to capitalize on this short window, which will be shortly lived before the market really starts to crank next year and the following few years. So another thing I like to keep an eye on is the unemployment rate. So historically, once the unemployment rate starts to tick up, it then runs. So I guess the 90s recession we had to have, 1990, once it started to run, it went up within a couple of years. And then we recovered down into 2000. And then this is the 2000, the dot-com bust, where it started to rise and then bang. And then we recovered after the dot-com bust, where unemployment got low. And then this is the GFC, where it started to rise and then accelerated. And then we recovered and we had massive spike because of the shutdowns and during COVID. So we're starting, the unemployment rate has been the lowest since the mid 70s. So it is coming off a very low base, but this is something that I'm keeping an eye on because once it starts to go, it gets up to say 5-6% unemployment, it'll run, and then that will be the indicator that the land-driven downturn has commenced. So uh, probably a year and a half, 2 years away from it running. But this is something to keep an eye on. And also something to keep in mind that now's the time to get your house in order, make yourself valuable at your job so you can keep your job when we go through the next land-driven downturn. Also, now is a good time to um, start cashing up, putting money in offset, having a healthy debt to value ratio, not being over leveraged. I guess the biggest risks in property is having interest rates rise, so the cost of debt rise, but then also losing income, either being from your job, your day job, or your tenants losing their jobs. So these are the things you got to be mindful of. Carry solid cash buffers to allow you to sail through tough times, but then also have yourself set up, cashed up, ready to go during the tough times because they're the best times to buy. Best time is when it's blood on the streets during, the last 2020, best time to buy during lockdowns. I was buying everything less than 200 grand. The GFC, best time prior to that. Dot-com bust, 91 recession, 1973 recession, 1955, 1933. Keep going back every 18 years and the mid-cycle slowdowns in between those 18-year periods are the best times to buy. So, but you also need to be able to maintain a solid cash flow and cash buffers to allow you to sail through the tough times as well. So brings us to the 18-year land cycle. We are on the yellow marker. We have well and truly recovered out of COVID slowdown or the mid-cycle slowdown for COVID, and we are well away at the races. And we have commenced the last final couple of years, so 2 years, called the winner's curse, which will really become well known and materialize, I believe, next year in 2025 and 2026. Historically, years ending in 5 are very bullish years. So before 2025, as an example, was 2015. So a good run up prior to the peak in 2019, 2017 to 2019 peak. 2015 was a very strong year. Prior to that was 2005. So where we are sort of equivalently today or coming into 2005. So 2005, 2006 were very bullish years where we had higher interest rates, so allow banks to lend more money, create more credit into the market, find more creative ways to allow lending. There's also commentary now that APRA or the government is going to potentially look at trying to make APRA reduce their 3% buffer, which banks already don't put the buffer on if you're refinancing to certain banks. If you've already got the debt and you refinance to another bank at a lower rate, they don't put the 3% buffer on certain banks. So we're going to see more of these creative ways to allow lending to keep moving, because ultimately the government wants to keep the economy stimulated, wants to keep the wheels turning, and credit expansion is a very powerful way to keep that going and ultimately kick the can down the road. But once the market turns, something will have to give. So we're on the cusp of this last real speculative boom. So where you'll see Brisbane, Perth, Adelaide really take off and it'll be mainstream. It'll suck all the punters in. Um, I mean, especially if they get sucked into new and off the plan and house and land packages, which will be a common theme that you'll see people buying in these markets, but it has become more risk to the downside for Brisbane, Perth, Adelaide than the upside. Um, I mean, we were buying a lot in Brisbane between 2019 to 2023, which was good to get into that market, I guess, sowing our seeds prior to it kicking into its significant bull run. And especially in like 2019, 2020, most people were talking down Brisbane markets um, because it had gone through a protracted 9, 10 years of flat growth, and we were buying stuff for cheaper than people paid in 2013, 2014. But that's the same commentary we're hearing now down in Melbourne. So Melbourne is looking like it did in 2018, 2019 when we talk about Brisbane. So we're now capitalizing on Sydney and Melbourne now until probably around 2030, sowing our seeds down there, investing down there to get great deals under bank value, under replacement costs, great yields to get in before the herd, before it then kicks into its next growth cycle, which will commence in the recovery after the 2026 peak. So market is due to peak based off Phil J. Anderson's work and Akhil Patel's work in April 2026 in the States. Australia trails historically 6 to 12 months behind the States, so we can expect the property market or the land cycle to peak in Australia towards the end of 2026. Come 2027, it will be on its way down. And 28, 20, and 29, 30 will be the trough of the next collapse, which is the best time to buy. So make sure that you're cashed up now so you can sail through the higher rates and then have enough funds in the bank to withstand losing a tenant or two or losing a job, because that's obviously another risk, losing income, but then being in a position to be able to buy because it's the best time to buy during these downturns. So I guess Warren Buffett sold recently half his portfolio or half his stock shares in Apple, sitting on his like Berkshire Hathaway, his company is sitting on 280 or 300 billion in cash. So he's cashed up. He sees the writing on the wall. He's getting ready for the next downturn because that is when the best deals are received. It is where the biggest wealth um, transition is, or wealth transfer are made during the downturns, where people get forced to sell, and the people that have seen the downturn coming, who are prepared and get themselves in a good position, can then capitalize on very good prices that are well and truly under market value, that are not sustainable to stay at those low levels. So that's what we're doing. Personally, I'm also starting to develop a few of my sites up in around Queensland. I mean, one of the towns that we are heavily, well, I've got 3 houses. I can now start to talk about these regions now. Now that they've gone gangbusters, we're no longer advising clients there. So Dalby is a place I've got 3 houses up there. It's about 50 minutes northwest of Toowoomba. They've pretty much doubled in value since I started buying in around 2020. 3 sites, they're on about 900 squares, looking to build 3 townhouses on each of those sites. So that's in the pipeline for my couple of my land holdings up at in Dalby. I've got other assets, so a couple of townhouses in Brisbane, some houses also in around Ipswich and Warwick. So looking to add value now in Queensland, like refinancing the loans because they've doubled or even gone up 150%, to then develop them, so subdivide or knock down and build 3 townhouses. And then the 2 individual units that I own that are within a complex, I'm going to renovate them come 26 and then sell them. I bought in that Logan area, one for 152 grand, the other one for 165. So I'm going to exit the tenants. One needs a new bathroom, one needs a new kitchen. So give them a bit of a spruce up, and I'm going to run them into auction. Fine, I've got an idea of the agent I want to use, but I'll find pretty much the best agent in that region who's setting records and run them to auction, and they'll sell like hotcakes. And if I sold them today, I could probably get around 400 grand each, easy. But I think by mid to late 2026, they'll sell for 500 a piece. So I'll pay down the debt, raise cash, and then reinvest that into blocks of units down in Sydney and Melbourne, and or the regional New South Wales or regional Victoria. So I say sell an asset provided you will get a decent capital gain. Yes, you'll, I guess, pay the capital gains tax, but if you can redeploy that capital gain, so in my scenario, I'll have, say, each of them would net 250. That's a deposit for $1 million asset, so $1 million block of units, which come 2028, 29 down in Victoria, you could be getting anything, block of 5, block of 6 units. So if you're selling one to buy 5 or 6, it's a no-brainer. And then you can scale and move to that next level. So that's how I'm looking to trade the 18-year land cycle. Obviously, I've got other stuff like stocks and other investments, which I'll look to liquidate come late 25, early 26 to cash up to avoid the 50% decline in the stock market. I mean, this is by no means financial advice. This is just my story of what I'm doing. Take it with a grain of salt, but this 18-year land cycle is by far the most valuable piece of information you could study, and will help you have clarity and cut through the noise. Everyone has the data, but it's what to do with the data and how to interpret the data and understand where the markets are heading, because not all markets move at the same time. So Sydney and Melbourne, for example, have gone through 8 to 9 years of flat growth, which markets typically do. They go through a period of, say, 10 years of flat, and then they go through a period of 4 to 5 years of absolute crazy 150% growth, and then they top out, come back maybe 10 or 15%, then go through another 10 years of flat. So using the 18-year land cycle, you can find where these markets have been going flat for a number of period of time, for the years on end. So then we like to get in towards the end of that, 8, 9, 10 years of flat growth, because it's only a matter of time where they'll kick into their next growth cycle, rather than what 99% of people do are now rushing into Brisbane, Perth, Adelaide, and they get themselves into a market that's overheated, overpay, even do something worse like buy something new and off the plan, and get wiped out when the market turns. So we don't do that. We invest counter-cyclically based off our studies of the 18-year land cycle. So that's where I see the market heading, and that's what we're doing. We're adding value. So all our clients that have property in Brisbane, Perth, Adelaide, it's now a good time to add value. So renovations, additions, subdivisions, knock down, rebuild, develop, is a good time now, because values are very high. So it's making it all stack up and worthwhile to start adding value and doing more of a build to rent model in those regions. And now is a great time to, if you've got the capital, to sow your seeds down in Sydney and Melbourne and regional New South Wales, regional Queensland, regional Victoria, as they are more suppressed markets. So buy in the suppressed markets, add value, develop in the hot markets is the way to go. So I guess more simplistically, this is how I see the market currently in 2024. Melbourne's probably got a little way to go to soften. Sydney's certain pockets, depending where it is, it's up and down, but between bottom to rising rents. So rents rising is also a good indicator that prices then follow, because you never really find properties, especially in the metro markets, with a 10+% yield. Reason for that is the rents rise and then the prices then follow then on after. So we're getting yields of 6-7% in Sydney, so prices are starting to rise. Melbourne, probably we're getting, I guess, on purchase price around that 5 to 6% yield. But once you turn over the tenants and give it a freshen up, and then you can rent them out for market, if not push the rents a little bit higher, then you're getting that 7% high, like mid to high 7% yields. So a good time to buy in Melbourne and Victoria. And I mean, people ask me, if it's low competition and it hasn't hit the bottom yet, why is it now a good time? Well, you never really know where the bottom is until the bottom's surpassed, and you look back in 6 months, 12 months time and say, shit, that was the bottom. So I like to double down when the markets are going, coming to, 8, 9 years of flat growth, and it starts like time to buy. Why try to buy every 6 months? So I'm putting my money down there, because it'll only turn at some point. And I like buying in suppressed markets, because then you can negotiate harder on multiple different deals, and then ultimately it's about getting the deal. And if you can get your property for anywhere between 50 to 100 grand under what the RP data or the bank values are, it doesn't matter if the market's still going to be soft in another year or two, because you're already making a profit on the way in. So provide you can get a good deal and get it for 50, 100 grand under bank value, you can then refinance, borrow your money back out of it without even needing the market to move and do the heavy lifting. So it's all about getting the deal. And you can't get deals now in Adelaide, Brisbane, or Perth, because the market's moving so fast. It's gone past all the bank values, and the bank values are lagging 3-6 months after the market. So you pretty much have to pay over bank value, and that's not a very good idea to do, because at some point the markets will top out. I see Adelaide pretty much close to the top. Brisbane's in FOMO. I mean, everyone's talking up the Olympic Games and that, but you need to get into the market 3 to 4 years ago, ideally. Perth, Perth's on the way. Perth's going to keep cranking. Um, But I typically like Brisbane, Sydney, and Melbourne. They are the most diverse economies. They're not solely relying on, I guess, mining. Perth is really a big mining town, so it has these massive booms like we're seeing now. But before, I guess, 2022 was 15, 16 years of flat to backwards of 30, 40%. So um, it's not a consistent and I guess, sustainable economy. It may, Perth may over time become more um, consistent as the economy becomes more diversified. It is close to Asia too, so it'll probably get a lot of Chinese investment down into Perth. So over time, it will probably diversify and become more of a stable market. But in terms of for this cycle, I think Brisbane, Perth, Adelaide are well and truly ship has sailed, and there's a lot more better opportunities down in um, Sydney and Melbourne. So that's those markets. Just a bit on politics, where what's been happening and how I see it all playing out. I mean, the government is modelling whether to abolish negative gearing. I mean, for myself and my clients, that won't really impact us because we focus on positive geared properties. We don't look to buy heavily negative geared. Like they might be slightly on day one, but once you turn over tenants and boost rents, they become positive. So um, it won't impact us. But if they get rid of it, it would only disincentivize people to invest in property. Therefore, there would be less investment properties, being less rental accommodation. When there's less supply of a product, the demand is only ever increasing with this overseas net migration and the country growing. So in population, the demand's never going to back off. It's only increasing. So if the government's going to disincentivize investment into investment properties being more rental accommodation, they'll reduce the amount of rental stock. And if they reduce the amount of rental stock, the prices will just go through the roof. So they tried to do this a few years back. I mean, it's more so, I guess, getting pushed by the Greens, but they don't quite understand property economics. So um, it's not the investors who are stealing all the investment properties from the renters. It's the amount of demand coming from the migration, and there's not enough housing stock to house all the people in the country. So the government needs to incentivize investment more, so there is more development and there is more property investment and there is more construction to build more housing. So I don't think they'll get rid of it. I think it's just smoke and mirrors politics, but wait and see. If they did get rid of it, it would actually probably play in the favor of property investors as rents would rise. It will balloon out of control, and then those higher rents will then get capitalized into higher prices, and it would actually, I believe, set off a property boom. And it would be completely counterproductive to the people that they're trying to support, being the renters. So watch this space, but I don't see negative gearing going anywhere anytime soon, especially that now that we're in a supposed housing crisis. So next one is they continue to run the biggest migration program in history. I mean, Albo is doing that to keep GDP in positive position. I mean, we're in a negative GDP per capita, but the headline GDP is positive, and that's only been driven by the net overseas migration coming in here, spending money, need housing to keep the economy hand kicking down the road. Because if he backs off on the migrants, would drop into a technical recession and he'll be voted out before he knows it. So it's politics, but that plays in the hands of property investors. If they're bringing in record numbers of migrants, they need places to live, and there's not enough housing stock. Rents will keep rising. So bring on the migrants, I say. Um, I mean, they're trying to build 1.2 million homes. Um, big number. I mean, Harry Triggerboff builds typically 2 to 3,000 units, apartments per year. He owns about 80,000. So the biggest developer in Australia, the biggest one doing it, only adding a couple of thousand of new housing or new stock onto the market every year. If that's what the biggest developer's doing, then how the hell is the government ever going to build 1.2 million in a couple of years? So that's a pipe dream, completely overstated. And I mean, there's no way that they'll hit it, but good targets, but at least probably set a target they could more or less try and hit. But that's all good. So the next one, Victoria land tax threshold 50 grand. So that's suppressing investment too down in Victoria, but that's also unsustainable. And it only takes a Liberal government to come in and wipe that, or they'll probably, even Labor will probably increase it at some point once in order to try to stimulate their economy down there. But I see it as an opportunity now. It won't be at that threshold forever. Tenancy laws in Queensland, New South Wales are now turning more favourable to the tenants, similar to what's in Victoria. So, I mean, you can only push rents once a year. Now it's connected to the property and not the actual lease. Um, Longer notices to inspect the property. Uh, I guess more or less harder to vacate the tenant without reasonable um, reasons to do so. So, I mean, screen your tenants, work with your property managers, make sure that you've got a solid tenant, um, because it is becoming more pivotal to the tenants. So it's just another layer of risk to mitigate. But if you work with your good property managers with an agency sort out good tenants because they don't want high management or having to constantly go and chase tenants for rent or fix things. So if you work with your property managers, they are best ones to really screen the tenants. So make sure that you're doing that and selecting the right tenant for your property. I mean, just touch on the greens, but we won't dig too deep into this because it's never really going to happen. They want to scrap negative gearing, cap the number of investment properties, freeze rents and mortgages. So that would never happen, but if it did, it would only send the property market higher because I mean, they're back to my first point. It's restricting or disincentivizing property investment. If you're restricting property investment, you're reducing rental accommodation. If there's less supply of a product and the demand is still there and growing, the price for that product will go up. And in this situation, it's rental accommodation. So, property economics 101. So, watch your space. I doubt that it'll ever get up, but it's pretty ironic considering the people that they're trying to support, being the renters, those sort of policies would only make it a lot harder. So watch their space. Next up is just a bit on the US politics. I mean, we're coming into November now, and it's neck and neck, depending on what polls you look at. So two ways it could go. If it goes Trump, he's going to cut taxes more than what Ronald Reagan did in the 80s. He's even talking about getting taxes down to 15%. And you may be thinking, why is this important? It's the US, it's not Australia. So the US leads, and Australia is dependent on the US like it is with China and the other countries around the world, the UK. So when the US does well, or even the saying, when the US sneezes, Australia catches a cold. So when the US is doing well, Australia will do well. So this is why I like to keep an eye on what's going on in the States because they also lead the 18-year land cycle. So if Trump comes in, these next couple of years, while we go through the final few years of in 2025 and 2026 before we hit the peak will be off the charts. And the reason for that is his policy. So he's going to cut taxes to 15%. He's going to have no tax on tips, overtime, or social security. So that's just free money. Cut regulations. So lending regulations, he'll put the onus back on the borrowers and not the banks. Cut all business regulations to cut the red tape to allow productivity and allow work to progress. He'll drill oil to lower energy costs because energy cost goes into everything, goes into transport, goes into food, goes into building materials, labor, goes into everything. So if it costs more to run an organization, a business from the energy costs, it'll all get filtered down to the end product or services they're providing, and it'll go onto the end consumer. So by drilling oil, which the US has as much oil as Saudi Arabia, they can then compete with Russia and Saudi to lower oil price. That will then be seen at the petrol bowser globally. So fuel prices will probably get down to $1.20, $1.30 again. And then when you've got more money to spend because you're not spending as much on fuel or on energy costs as your gas bill and electricity bill, that'll lower inflation. It will then allow him to cut the federal funds rate, which will ultimately be soaked up by higher property prices. He's a property investor, multi-billion dollar property developer from New York. He's got vested interest in property development. So he knows that by cutting regulation, cutting taxes, creating more credit available in the economy, drilling oil to lower energy costs so people have more money, and then also allowing him to then drop rates because inflation is lower. That'll allow people to take on more debts. Those more debts will get soaked up by property prices, and then it'll just absolutely pump for the next few years before the market turns. And not to mention, he's also pro crypto. So it'll be amazing to see if people start using their crypto wallets as security to go and take out loans to buy property. So I won't be surprised if I see that if Trump gets in. So Trump comes in, it is going to be like the roaring 20s, like no one has ever seen before. So that's one scenario it could play out. The other scenario, if Harris wins, I mean, similar story. The cycle will continue to complete, will continue to boom into 2026, and then we'll go through the next land-driven downturn. But it would be a more modest, I should say, boom. Not if Trump comes in, it'll be completely off the charts. But if Harris, I guess, stays in, it'll be much of the same of the last couple of years. So not as completely speculative and off the charts in terms of the capital growth, but it will still continue to the market will still continue to perform, and even her policies still play into boosting property prices. So she'll continue record migration on the southern border. So migrants coming in, more demand for housing stock. They're also in a housing crisis as well, not enough housing because they've let in good 20 million of migrants over the last 2 or 3 years. So that's huge numbers. So that will continue. She's proposing 25K for all first home buyers. So, I mean, to help them get into the housing market, but I don't understand why these politicians don't get that when you give people more money, they can just spend more money. So that'll also get soaked up by higher property prices. It's like putting fuel on the fire. Their green energy policy, so no drilling for oil or gas. So when they don't drill for oil or gas, higher energy costs, higher inflation. Inflation is actually good for property investors. It will inflate the value of the property, but then also devalue the debt that you've got associated with it. So that'll also play into the hands of property investors globally, because if there's a restriction on oil and gas in the States. That will have elevated oil price globally. And she's even talking raising taxes and tax on unrealized capital gains and price control. So, I mean, that is just disastrous. I mean, you can't increase taxes and then expect to not allow businesses to pass on the cost. So, uh, time will tell, see how it all play out. But that is just going to be like having the foot on the accelerator and the handbrake on at the same time. And a lot of businesses will feel the pain and more than likely get wiped out, especially when we enter the next land-driven downturn. So Harris, if she gets in, will be a more modest boom in the next couple of years, and then with a more modest bust. Trump will be a bigger boom followed by a bigger bust. So let's wait and see how it all plays out. Bit of housekeeping. As always, this is by no means financial advice. I'm not a financial advisor, but I am operated as a buyer's agent. If this content is any of value to you, like, subscribe, share with anyone. You can always reach out. My email is on the screen there, and I'll put my details in the comments below. If you need help buying your next investment property and position yourself well within the 18-year land cycle, I'm your man. I can help you 10 properties, 10 years conservatively to build a solid residential property portfolio. So just before we go, I've got some extra data, which I didn't put into the slide pack tonight. Um, but what I would like to show is just make sure I'm sharing the right screen. Is US housing stocks. So this is a bit of geeking out for you. So as the US economy leads the 18-year land cycle and Australia trails 6 to 12 months behind, you got to keep an eye on the US and what the hell is going on in the US, because once the US starts making indications that the market's turning, then we know where we are at 6 to 12 months behind. So the US housing stocks, being property developers, house and land package developers who buy land, build houses, sell them, is a really good indicator to show where the market's heading. Because in the GFC, as an example, housing stocks, so this is DR Horton. I've got three as an example. We'll go through this stock price for now. So in July 2005, this home builder share price peaked, and then it started to decline in 2006 and 2007. So meanwhile, this is a good indicator to show that the land cycle has started to enter the land-driven downturn, is when these home building stocks start to decline. And when they do start to decline, it'll really slip under the radar. No one will see it. I guess no one in the mainstream will see it. Um, the the index will continue to perform, but these home building stocks will start to decline before the rest of the market tops out. So this is a good indicator to keep an eye on. So that's what happened in the last, or the GFC, or the last land-driven downturn. So where we are today, they're still at all-time highs. So once we start seeing these um, home building stocks starting to decline, then we know that the US has entered the land-driven downturn, and then we'll be 6 to 12 months behind. So again, this is another one. Halter Group peaked in, I guess, again, July 25, 2005, and then started its decline in 2006, and then by 2007, the market was heading south. So all-time high still, but these are ones to watch and to get a good indicator of when the market's going to turn. So again, Lena, Lena Corporation topped out July 2005, and then 2006 they were heading south without many people realizing until I guess it was like October 2007 is when the GFC supposedly started, but it already started with the home building stock. So this is also at all-time high, hasn't started, but I'll be sure to be keeping an eye on these uh, most, I guess, the largest home builders in the States, because this is, I guess, the best leading indicator of when the market is about to turn. So hope you all enjoyed that tonight. As always, this is by no means financial advice, but I can guarantee one thing: if you do not take action, you will not get anywhere. Until next time, thanks for watching.